Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Sonali Basak, standing in for Matt Miller today. Katie, what are you looking at today?
It is the final trading week of August, and it's been a pretty brutal month overall, I would say.
Pretty brutal. Down up for the most part. Looking at some green on the screen finally. We're going to talk about the biggest stories right now, though, in the more than $10 trillion global ETF industry, starting with the big story. Fed Chair Jay Powell laying out the central bank's policy approach over in Jackson Hole. We're going to look at positioning in the bond ETF flows as investors search for direction.
Plus, China takes action. Authorities take steps to bring investors back to one of the world's worst performing equity markets, Sonali.
Yeah, absolutely. And we're going to look for the next wave of momentum in markets. Summer is drawing to a close, and we're going to look at one ETF looking to ride the next rally or the next sell-off.
And Sonali, Eric Balchunas from Bloomberg Intelligence, back with us now after a little time off, looking at the flows. Eric, what do you got?
Katie, Sonali, you nailed it. Summer is coming to a close. In fact, for stocks, it may be over already. Look at the flows here for the 1 week. Bill, right? That's short. That's basically cash. You've also got inflation-protected ETFs in there, as well as intermediate. You've got some floating rate in there. So again, that's people maybe preparing for rates going up again. And 6 of the top 10 are bond ETFs. This is a far cry from the summer where equities really took over the leaderboard. Let's look at the outflows, and you can see at the top the Qs. You hate to see it. You know, the Qs is a bullish ETF. The trading crowd loves it. They're getting out. Look at the 1 day, negative 2.3 billion. And look at the 1 month, 6 billion out of the Qs. So people taking profits there, a little nervous, and it's showing up in the flows. So let's take a minute to take a big step back and look at our FOMO drought indicator, which is a chart my colleague Andre Yap made. Basically, this looks at equity ETF flows minus fixed income ETF flows. Equity ETFs always taken more. So if they're above this line, that means equities are taking in money. That's normal. Well, remember this year, bond ETFs started yielding a lot, so people came into the bond ETFs, but then equities started really surging. And so better than a 5% yield might be a 10% rally in stocks. Stocks started taking a lot of cash, but look what's happened now. Even though the drought has ended, fixed income starting to pull that number back down. And it'll be interesting to see how this plays out. So for equities, yeah, summer looks like it's over.
Okay, so for equities, summer's over, but for bond investors, maybe the fun's just beginning. Let's get into it now with DJ Tierney. He is Senior Investment Portfolio Strategist over at Charles Schwab, of course, the 5th largest U.S. ETF issuer. And I want to start, DJ, where Eric left off, particularly if you look at short-term bond ETFs, those cash-like products. You've seen a lot of money come back into them in August. What do you think's behind that big? Why the sudden love for the short end again?
Well, I think there's just a real appreciation for the safety and the income that bond ETFs, short maturity bond ETFs, can provide. And if you look at the big picture, you know, there have been massive amounts of flows into fixed income ETFs year to date. And really, we think this is just the tip, just the very beginning of what's to come. There's a potential major asset allocation shift where people can really take advantage of the yield and income that's in bonds. It's really for the first time in the better part of 20 years where you've had this really attractive relative value of bonds versus equities.
I'm curious about bonds versus money markets here, because in the most recent quarter, there was a whopping 140% jump when you look at Schwab's movement into the money market funds. When you're sitting in the ETF business, what kind of competition are you facing from money markets themselves? And are you seeing any forms of rotation?
So, you know, it's great that investors have many choices, right? If you just step back and think about big picture, the alternatives that investors have now, right? Money market funds giving these big 5+% yields, the opportunity that you have in fixed income, whether it's treasuries, corporate bonds, high yield bonds, the costs that have come down, it's really amazing, you know, and I've been in this for a while. And if you go back, you know, bond ETFs came on the scene 20 years ago, but for most of the last 20 years, we've been in a zero interest rate environment. And so now for the first time, you've got this, you know, 600 choices in the bond market. You've got all these different choices, all these low costs, and now you also have yield coupled. So we think it's a good news story that investors have so many alternatives. You know, at Schwab, we offer the whole spectrum, right? We're a sizable player in money market offerings. We're a sizable player in ETFs. We're a sizable player in separately managed funds. So, you know, we want to meet investors where they are.
I want to talk a little bit about your business. You know, you do have a lot for everybody. You're a full service provider of ETFs. You're currently in 5th place in assets. And this year, you're also 5th place in flows. So you're punching totally within your weight. But JP Morgan and DFA are above you in flows this year because they offer cheap active. And that's been a real big hit lately. Once active got below 40, 30 basis points, it's been taken off. Do you have an answer for that? Do you plan any active ETFs en masse?
Well, we do have one active ETF now. We look at everything. So I wouldn't rule anything out for the future. But as you know, our 30 ETFs now are primarily focused on low cost, kind of foundational building blocks for a diversified portfolio. Speaking about the new entrants, though, again, more competition in the ETF space is good for investors. And if you think about the providers you just mentioned and several others, they've entered the ETF space in the last 2 or 3 years, right? So they're late, but we'll welcome them to the party, because ETFs offer so much in terms of efficiency, tax efficiency, easy access. So we think competition's great. A lot of what you're seeing there in that space is a bring your own assets. Like if you look at the assets that have flown into those products specifically, in many cases it's a shift from other active assets they had in the mutual fund form. And so that's a big part of the flows. But I won't, discount the fact that active ETFs offer some competitive advantages versus active mutual funds.
It's a good point on bring your own assets, and I think Eric trademarked that phrase. We'll have to convene about that off air. But of course, when I think of Schwab and I think of the ETF business, Schwab, I think of the 34 million brokerage accounts that you have. And when it comes to building up assets in your ETFs, how much are you looking to that audience that you already have within Schwab's universe versus outside investors, if you will?
Yeah, we'll meet investors where they are. So yes, we've got a great brokerage firm with 400 branch offices, and as you said, millions of investors. But we serve advisors as well, independent advisors that custody at Schwab. That's a big part of our audience that we're serving. And then in the last few years, we've also met investors where they are off platform. And there's a lot of investors, institutional and retail investors, that are outside the Schwab ecosystem that are choosing to utilize our products because of what they offer in terms of low cost, efficiency, and the ability to track the index.
And so you just rattled off a bunch of advantages of ETFs. And when you and I met in San Francisco about 1.5 years ago, you were talking about direct indexing. And this is a big debate on our team. I'm bearish. I think the ETF era is here to stay, and direct indexing will be really niche. Right now, it makes up 1% of the 34 trillion in assets among vehicles. Where do you see that 1% going? I see it staying at 1%. What do you think?
I think it's got some potential to grow. I mean, they're very, very different vehicles, right? ETFs, span the whole asset class spectrum, where direct indexing, for the most part, is a core equity strategy. But for taxable investors in a high tax bracket that have capital gains exposures, I mean, you can really make the argument that direct indexing, personalized indexing, if you will, is a better alternative for those investors. So where it fits really, really well. To your point, shouldn't have been positioned as a replacement for ETFs. It's just another choice that can help investors have better long-term outcomes.
All right, see, we can all live in harmony. It's a beautiful ecosystem of investing. DJ, we got to leave it there. Really enjoyed this. That is DJ Tierney of Charles Schwab. Now, coming up on ETF IQ, as China's economic troubles deepen, EM ETFs feeling the pain with big outflows. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with quality stocks. You're looking at iShares Quality Factor ETF, ticker there QUAL. I had to think about how to spell that. Currently up about 20% in 2023. Of course, this screen stocks based on leverage and factors along those lines. It's handily outperforming the S&P 500, up about 15%. So a lot of love for quality, not so much when it comes to thematic ETFs. If you look overall so far, thematic ETFs on track for the worst year of outflows going back to 2001, $2.6 billion leaving that category. Of course, a lot of those outflows coming from Cathie Wood's ARK lineup. Let's also talk about China, because of course, as China tries to unleash stimulus measures to help its economy, you're not seeing that much enthusiasm when it comes to investors. You're taking a look at ASHR, this China-specific ETF right now, on track for a third straight week of outflows, or rather EM ETFs overall, but of course, a lot of that coming from those China products.
And you certainly see some of the pressure on some of those largest emerging markets ETFs overall because of that China exposure. We're going to talk more about this issue with Bloomberg emerging markets reporter Carolina Wilson. Carolina, when you take a look at kind of the iShares ETF for emerging markets, for example, you certainly see that pressure. The biggest holdings being among Tencent and Taiwan Semiconductors. What's the problem for investors mostly?
Sure. So when we look at these sort of mammoth passive EM vehicles, you're looking at things like ticker EEM, that's the iShares product that you mentioned, and investors are really pulling cash out of that. Right now, it's on record to have its worst month of redemptions in about a year. And when you drill down to the holdings, like Sonali is suggesting, you do see some of those Taiwanese names, but you see close to 30% exposure to Chinese equities, and that's just a number that investors can't stomach right now.
And so it's coming out of these products, the cash. Is it staying within the EM universe broadly, or where's it going?
It's a great question. I'm seeing a few trends emerging here. Ticker EMXC is one that you've probably talked about. It's an interesting fund. It's tracking emerging market equities, but it's totally stripping out China exposure. So it's a very blunt sort of way to invest broad EM, but taking out China. Another trend that I'm seeing emerge here is actively managed funds, which is interesting because active versus passive is this conversation that's always humming in the background for the ETF industry. But I'm really seeing a pivot now where investors look at these passively managed funds, they see the high China exposure, and they think, is this a time to go active where I can have a portfolio manager or a team that can make adjustments to these holdings and not give me as much exposure to China?
What exactly are those actively managed ETFs buying?
So you'd think that because they have the power to strip China that they would. But what's interesting is when you look at the holdings, there's still some Chinese equities. And they tell me that's because investors who look and they say, here's my portfolio construction, here's my bucket for EM, here's my bucket for risk allocation. They don't want that to look totally different from a classic EM playbook. They still want some China exposure. So the active manager will go, they'll maybe underweight China, but then they'll overweight countries that have more bullish outlooks like India, Brazil, and Mexico are some country names that have come up.
So interesting, not invest or dumping China altogether. What are you hearing investors about what they want to see before they really step back into some of these China ETFs? We've seen a lot of piecemeal stimulus, but what about a big package here?
So they're going to be watching the data super closely, and I know that there's sort of concern about how reliant that data is, but this is really something that we follow on a day-to-day basis with flows. So on Thursday, we'll see PMI data. That's going to be very telling. It's probably going to come back weaker, maybe not as weak as in the past, but that'll be something that investors will watch when deciding where to allocate.
All right, Carolina, great stuff, great reporting. Our thanks to Bloomberg's Carolina Wilson. Now, still ahead, we're going to speak with Jay Hatfield, founder and CEO of Infrastructure Capital Management, about MLPs, oil, and so much more. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Katie Greifeld, along with Sonali Basak.
And Eric Balchunas from Bloomberg Intelligence is back with us for today's drill down. Eric?
Sonali, today we're going to look at AMZA. I think this is the first MLP ETF we've done on the show in the drill down, so this should be a good conversation. MLPs are master limited partnerships. People like them for yield. It's a pass-through income, yet they're definitely involved in the pipeline oil industry, so you're going to get sector exposure to energy. You can see the expense ratio here is 1.4%. That's not all the management fee. There's also a tax-deferred liability embedded in there because to own MLPs fully, you got to be structured as a C Corp. It gets a little wonky, but just know there's a tax hit in that fee there. It's actively managed, so this is going to go out and stock pick for MLPs that it likes that give good income. It yields about 7%. Let's look at the holdings. And you can see that this is all MLPs, right? Some MLP ETFs don't actually own all MLPs. This is one that's fully invested in that area. And then let's look at the performance of AMSA versus AMLP, which to me is the kingfish of the category. AMLP has about $6 billion, AMSA about $300 million. I look at the last 2 years. AMSA was underperforming it prior to that, but has had a nice run since. It's up 55% versus 46. But look at the price return versus the total return. This includes the yield. That's how much the yield pumps up your total return there. So yields, total return, that's what people go to for this. And if the active management working, you should see some looks in this ETF, Katie.
Eric, thank you. And joining us now to talk about this ETF is Jay Hatfield. He is CEO and founder of Infrastructure Capital Management, who manages this ETF. Jay, it's great to have you on set with us. Let's talk a little bit about the interest here, because as Eric just showed, the performance has absolutely been crushing it, especially when you compare it to something like the S&P 500 or to bonds for that matter. And yet we really haven't seen the inflows to match it. How do you explain that little bit of a disconnect that's forming?
Well, MLPs have been a challenged asset class over the last 5 years because you had a crash in energy. And so a lot of investors kind of got burned by that, but I think that creates an opportunity because I think they're still undervalued. And but it's challenging when we talk to advisors. Our fixed income ETF, which is preferred stocks, gets way more inflows because it's less controversial asset class. So a lot of times we'll talk to them about that first and then sort of MLPs second because of their clientele having had issues, but therein lies the opportunity. Their companies really fixed themselves. They have better coverage, lower leverage, and oil prices are pretty stable. So it's been a great opportunity. MLPs have outperformed the market over the last 2 or 3 years pretty easily.
You mentioned stable oil prices. You have a very interesting range that you've given to us, up to 95 bucks. What brings it there? If you think that if it were to spike to $95, is it kind of the season that we're heading into? Is it OPEC distortions? What brings us there?
Well, what we've done over the last 3 or 4 years is we always have a range. We try to make it a reasonable range. A lot of times you hear these big calls like we're going to 150, we're going to 0. If you look at our ranges, they've been pretty appropriate. We look at supply and demand balance, so that's a fundamental range. Sometimes it violates that. But we are going into a seasonally weak period for oil, which is it's called the shoulder months because there's just not that much demand. So we think we might trade closer to the bottom of our range, like 75. This is all in WTI. And then maybe later in the year when the market's rallying, strangely oil has some beta or some correlation in the market, you might get towards the top of the range. But at least we're not nervous about oil. A lot of people are concerned about inflation. We think we'll sort of range bound on oil.
So USO is a popular oil futures ETF. It's gone from covering all the months to just the front month again. Made news this week. Let's say you're looking to allocate to energy. Why use an MLP ETF over just buying USO to play the price of oil short term?
Well, first of all, I guess we're not really saying that oil is going to explode. So stable oil is actually better for MLPs than regular energy companies. They just need to have good demand and stable flows. So if you want to play stable oil prices, MLPs are superior. I wouldn't really recommend really buying commodities for a lot of retail investors because you're not getting the benefit of a corporation. Everybody kind of forgets, even investors, that when you own corporations, they retain earnings, invest it, hopefully at good returns, and you have a nice long-term strategy. With USO, a lot of times you go into something called backwardation, so that you lose money over time. And so it's actually contango. But you lose money over time by holding it, and it's expensive, and you don't get any dividends, you don't get any cash flow. So generically, even with gold, I'd rather own a gold miner than gold itself.
And I mean, USO has had a really interesting 3 years. I think we can say that. But I want to go back to MLPs as an asset class because, as you mentioned, it has its own challenges. And I thought the point you made that you talk about preferreds first and then MLPs with your clients. Have those conversations changed as we've seen the performance this year, or are people still wary? What's going to bring them back in?
Well, I think you sort of have true believers and then the non-believers,
Just
and also,
like Bitcoin.
Right, and so that's why we talk about preferreds. We think we add a lot of value because it's fixed income. which requires more active management than equities. But there's also a political dynamic. Some people think that we're never going to use hydrocarbons again, which I've been around too long to really believe that. So there's a little bit of a political element. If you call people in San Francisco, it's not going to be your first thing you want to talk about. But there are true believers. They've done extremely well, who've stuck with it. As you mentioned, USO was like negative 40 at some point. So if you bought MLPs, which one of the reasons we outperformed is we bought, we run a small amount of leverage. We added it back. We took it off and added it back at a really good time when everything was like $2, $3. And that's why we've kind of crushed it since that occurred. But so people who stuck with it have done extremely well. But then there's other people who want to be in solar because that's the future of the world.
All right, that's a good place to leave it, Jay. Really enjoyed this. That is Jay Hatfield of Infrastructure Capital Management. And Matt Miller, he's not here this week, but the dude did have time to dig into one ETF before he left.
Get ready to hang 10 with the Merlyn AI SectorSurfer Momentum ETF, known by the lovable ticker DUDE. This fund rides sector waves by using AI to learn market behavior. DUDE picks leaders in momentum during bull markets, then switches to a defensive strategy when there's a detection of bear market conditions. It assesses risks by using 4 key metrics: price trend, momentum, value sentiment, and volatility. When the fund's algorithms find bullish indicators, it evaluates more than 100 ETFs and aims to select up to 4 economic sector ETFs and up to 2 that are geopolitical. When a bear market is detected, the index selects 4 or more defensive ETFs, which consist mainly of treasuries, various corporate bonds, gold, and broad-based equity funds. It can hold just a single treasury ETF in excess market volatility. Despite the recent AI buzz and the great ticker, DUDE has badly trailed the S&P 500 in 2023 and posted negative returns since its inception in December of 2020. Its high expense ratio of 95 basis points also doesn't help. It only has about $20 million in assets. It does, though, get a green light in the Bloomberg Intelligence traffic light system with no warnings, which is at least something to be stoked about.
They didn't ask me to record the DUDE ETF. I wonder why not. I don't know.
I like this ticker. I got to be honest. Big Lebowski fan. It's hard not to. You guys seen that movie?
I just feel like if they made an ETF for Matt, it would be more bro, less dude.
And it would have cars.
Truck.
Motorcycles and cars.
TRUK. In any case, the DUDE ETF. Well, because of the Labor Day holiday next week, we'll be back on Wednesday, September 6th, I believe. Just another week where we're not on Monday. We're on Wednesday. And if you just can't get enough of ETFs, you can listen to Eric and Joel Weber on Trillions. It's their bi-weekly podcast that covers the industry. But for right now, that does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Eric Balchunas and Sonali Basak. This is Bloomberg.